We're good? Okay. So, all right, welcome back. Scott's here, caught in traffic.
Yep.
Yep, that's Phoenix, man.
Phoenix traffic. Yeah,
Phoenix traffic.
It's different now.
And it also helps if you have the right address.
Yeah, that's true. When you don't punch the right address in, I didn't copy and paste, so I was a little off.
Hold on a second. Remember that's going to be on delay.
Yeah, I'm not getting anything right now. It's okay. Keep going and on. Yeah.
We're good? Okay. Is it loud?
Delayed.
Is it very? Yeah. So it's interesting. So this is the second time. Well, no, we've streamed from Denise's studio a couple times. This is the second one I've had on the channel for this. And so learning, like, for whatever reason, I don't know why, but it's like about 20-second delay on live. So it is interesting. So anyone who happens to be watching, if anybody is watching right now.
Well, if we swear or something, we can cut it off.
Whoops. Dude, this is my channel. We can say whatever the fuck we want. So, all right. So, thank you guys, everyone. Thank you. If you're on here live, I don't think we've got anybody watching live right now. We got two. Yeah, but I'm probably one of them and you're the other one.
No, there's three.
Oh, nice. It could be one of the girls. So thank you. Welcome back to Outer Snail Productions. This is second episode of our Independence for Unity podcast. We've got Scott Coyle with us today, who is CEO of, well, it was ClickIPO, but you told me you guys have
changed the name to Click Capital Markets.
Click Capital Markets.
Yeah,
okay.
We're offering, besides IPOs, we're offering some other products now.
Okay, so you're expanding it. So
correct.
So Click Capital Markets. I can update that in the description.
Well, the Capital Markets is a parent company. The broker dealer is still ClickIPO. So I'm the CEO of two companies.
Nice.
Isn't that nice?
Man, you need to get like the little, like the military badges.
Yeah.
Just start stacking them up as you get more and more titles. So as always, or I guess not always, but it will be always, we're going to have this conversation over a couple beers because
nice.
Cheers. Yeah, cheers. We're drinking Deschutes Black Butte Porter today. Actually, I meant to have a bottle out here to stick it up here so people saw, but yeah, it's good. It's good stuff. And I've got my giant Bavarian mug.
I can't keep up with Eric. So I got the kid's glass.
Well, and also too, so if you are watching, I've got a cough, and so I'm on like 1.5 doses of the cough syrup, which I know if you take too much, it's like a hallucinogen.
It'll work well with it.
I know, man. So 1.5 doses of the DM plus all this beer. I don't know. We'll see. You may see me just start to go downhill by the time we're done with this conversation. So.
Well, nobody's driving. So.
No, and whatever. Who do I have to answer to? But myself. So I don't care. So what I wanted to talk about. So we'll come back to the ClickIPO stuff and what what you're here to talk to us about. But I did want to kind of go over just who you are. Get to let the viewers know who you are. So we first met surfing the wave pool at
Correct.
Big Surf.
Yep.
And actually, I got some fun pictures.
Oh, you do?
Yes. Denise, can you switch over to the presentation? So.
Also, William Kirchberg.
Oh, Bill's on. Nice.
Oh, that's Bill.
You know what?
Hey, Bill.
He's alive and he's wearing Scott's t-shirt.
Nice.
Billy boy, how are you, man? It's been a long time. Let's connect.
Yeah. Bill, thanks for logging in, man. Dude, so I took Shay and her friend up to Flag on Friday because her friend has driven up there a bunch of times, but I was like, I don't know her, I don't trust her if the weather gets bad. So I told Shay I'll drive you guys up there. But now I feel good. She seems like her friend is legit, has a Jeep and 4-wheel drive. But anyway, Bill, yeah, I was thinking about it. It's like, man, we got to get another
we got to get a boy ski trip in.
Yes, yeah. Although it was still all man-made. Yeah.
Well, they need some snow. As soon as they get some snow, we all got to go.
Right. Well, it actually wasn't too bad. They said that all the trails were open, but I can't believe that so there's a little outer snail guy that Denise made for me. One of our little logos. All right, so here we go. Here's some Big Surf pictures. Well, actually, that's a real photo of you.
Yeah.
Where's that photo taken?
I'm pretty sure. Well, it's probably not California because I'm not in a wetsuit. You know what? It's Zippers in Cabo San Lucas or San Jose
Nice.
del Cabo. I think it's Zippers. That's where that
Nice.
was.
That's a good angle because the
Yeah.
wave looks huge.
Yeah, it's the wave's probably knee high, but you got a GoPro on the front.
Right.
Looks like a head high wave, which
Yeah.
I'm sure it wasn't.
That's a good photo, man.
Yeah.
I know. And then I was looking for some Big Surf stuff, and I always liked that one from, we've got a few from Nighttime that
Yeah.
I can't. What was his name? Randy, I think, was taking
Randy
those.
took them all. I'm looking for you in there. Where are you?
Oh, dude. So I'm. Let's see.
Oh wait, you're right there, right?
Next to Shay. Shay's got the board with the like the blue and white Hawaiian print.
Yeah. No,
Yeah.
I see you. And
And
I'm in
then-
the back, all not second from the end. I'm kind of walking.
Yeah,
with the
you're
surf.
walking
I got
behind
the yellow
us.
surf, that 9-foot yellow board I had.
Yeah,
So,
you're over here. We've got the mouse here. I can point to it.
yeah.
There you are, right there.
Yeah.
You're like late to the game to get into the
Yeah,
picture, man.
exactly.
And then there's me in my old red shorts when I still fit into those.
It's pretty buff.
And then I'm working on getting back to that. And then
Cheers.
yeah, cheers, exactly. Cheers. And then Shay and Sean's in there. You can't really see it, but it's a good little shot of Sean with his like surfer bushy blonde
Yeah.
hairdo, and then Shay's down
God, they
here.
were so young then.
Shay's
so
there
little.
behind her board. And then here's Denise, my amazing, incredibly intelligent, beautiful.
And we can point out where Denise surfed. It was over on the left, all the way on the right.
Yep,
right-
Denise was always over
right
here.
there.
Right here. With Shay. Shay was always over there with her.
I
Yeah.
never left the corner, right?
That was like, and so then
If
you
I
would
wanted to
see,
talk to Denise, I'd have to paddle over.
I was
the
gonna
corner.
say,
hey, hi, how you doing?
you'd see me sometimes paddling over there to be like, hey, Shay, how are you? Oh, Denise is here. Oh, that's true. I chased after Denise for years and years. I'm sure if there's any other Big Surf people watching, they'd be like, yeah, we heard you talk about her. I'm sure they would.
Persistence.
Yes. Well, I knew how special she was. Yeah, you are. You're great. You're amazing. So, yeah. So, Big Surf. So didn't you grow up in the Midwest, or did you always
did.
surf? You did. Where'd you grow
Never
up?
did. I grew up outside of Chicago, and
That's right.
when I was right before my senior year, my dad got a job in Phoenix. He was running a printing company, actually back then when they actually printed things. So my folks wanted to move, and they kind of gave me the option. They kind of didn't want to go without me, but I was ready to go. I mean, I was kind of.
Oh, you were.
I mean, I grew up in the same spot, same kids. I went from grade school, junior high, high school. I was going to go to ASU anyway for
Oh.
college, so I'm like, nah, I want to go, And then I remember leaving, thinking, oh my God, it's the beginning of my senior year. Like, am I going to be okay here?
How was that then, going to a new school, new state,
know,
your senior year?
It was really good. It grew me up because I was in sports. I played baseball, basketball, and hockey. So I was in sports and knew lots of kids. And so it forced me to meet a lot of new people.
Oh, just
so
like
I'm walking into a school, the first day there, you don't know anybody.
you didn't have all these ready-made friends.
Didn't have ready-made friends. And I remember the first day there, on lunch, I went to Saguaro High School in Scottsdale. And on lunch break, they had an open campus, which it wasn't like that. It wasn't like that in the Chicago area, but.
Yeah.
On lunch, they had they were playing a Devo song, "Whip It Good,"
Oh yeah.
and that music was out here. Like New Wave was here already. It didn't exist in Chicago. I mean, I left Chicago. It was REO Speedwagon, Kansas,
Hmm.
Rush.
Yeah. Interesting.
You came out here. it was
REO
totally
makes
different.
sense. That's they're from
Yeah.
Illinois. They're from Champaign.
Rockford. No, Rockford, aren't they? I thought they were from Rockford.
Maybe they
not.
were. I just remember they
Yeah.
were from
So anyhow, came out here, went to ASU for 4 years. Was a marketing major at ASU, which I've never really applied. Marketing's totally different now than it ever would have been. And then I got into the securities business maybe 6 months after I was out of school. Got a securities license. And I started in the business, I think it was 1987, right before the stock market crashed.
Oh, okay. The Black Monday.
Black Monday.
See, I know some stuff.
Yeah.
That's all I know about it, though. I know the name Black Monday.
Well, it went down like 20%.
Yeah.
So.
Interesting. What was that about? Do you remember?
No,
What
I don't
caused Black
remember.
Monday?
I don't know what caused it. It just sold off. But for me, I was a new broker trying to open accounts, and so I was calling people, "Hey, the stock market's down. It's a great time to buy."
Yeah, no
I was
kidding,
like-
right?
I didn't have a whole huge book of clients that had invested money that
Yeah.
just went down 20% yet. So
Right. Hold on a second. There's one other thing I wanted to tell people watching. So if you are watching the recording of this, One thing I learned from our first episode is, so we're just gonna, shoot the shit and get to know Scott a little bit, and then we're gonna go into some of the details on what ClickIPO's mission is and some of the solutions that we might talk about as far as bringing IPOs back to improving access to retail investors. So if you want to skip through the upfront stuff, I'll do my best to get the video organized by chapters. So go ahead and just fast forward to those later chapters if you want to get to the solutions that we talk about. I noticed that because it's pretty cool. YouTube will do analytics on your videos. And the last guy I had on here, we talked about ranked choice voting and proportional representation. But when I look at the analytics, a lot of people didn't get to that point in the video. Like they'll watch about 40 minutes and then they'll turn it off.
Right.
And that's like right when we're getting to the stuff that I wanted people to hear about. So yeah, definitely. If you want to just skip ahead, please do that. And I'll do my best to get it organized that way. So, cool. So dude, the other thing as I've gotten to know you, so another picture you sent me, if I still have this over here, is you used to race share. It was a kit Cobra, right? It wasn't a full-fledged
Not a real
Cobra.
one, but it was a Cobra replica, but
Yeah.
it's an exact copy of the real one. It was actually a high-tech Cobra. There's only two there's 25 manufacturers out there now.
I was gonna say, because does anybody actually race the real ones anymore? They got to be worth too much.
They probably don't. Maybe in some vintage stuff, maybe a little bit, but not really.
Dude, I would, if I owned one, there's no way I would take it on a track with
they're
other
not gonna
people,
race it.
other cars on a track. No way.
Yeah, so that's it. So yeah, I had that car for about 10 years. I originally drove it on the street, and then I went to a road racing class.
Yeah.
And you had to go through class for 2 or 3 days, and then they would let you run it. And then I started somewhat racing it in groups. And the way they would do it is you would have a transponder in your car, and you'd go out there and run 20 or 30 laps. And then so you could kind of be spread out, and then it would be, the fastest time would win. But it wasn't. When you're on the track with other people, they're supposed to, point you by if you come by. I mean, there's some rules and etiquette. It wasn't really fender to fender where you're rubbing his racing. It's not like NASCAR.
Right.
But that picture's
especially when you're on your own. I mean,
that picture's at Road America. So I'm pretty sure to this day I've got the second fastest time at Road America ever.
Sweet.
So,
in a
Cobra. Yeah, in a Cobra. And I had a bunch of clients in NASCAR in the late 90s, early 2000s. And that actually, the motor in that's a NASCAR motor.
Right.
It's a 358 cubic inch motor. It was in Rusty Wallace's car for you NASCAR fans.
That's fun.
Yeah.
Yeah.
So
That's
it was
cool.
a blast. So yeah. I had that for a long time. Didn't kill myself. So decided to sell it and move on.
See, that's the thing is I would love to do that for real. I've done this. We've talked about the sim racing. I'm like, man, I would just if I had the disposable income, I would be out there, man, on track days for sure.
Yeah, and for your audience, Eric's very good in a go-kart, and he does this sim racing, and I'm like, well, that can't transfer. There's no way. So I spent a bunch of time in a Cobra and some in a stock car, and so we went go-kart racing, and Eric was a little faster than me, so it definitely transfers.
Only a teeny bit, like hundredths of a second.
Yeah, hundredths of a second, but he's still a little quicker. So my point of it is, there's no that has to transfer what he's doing. I was like, I haven't been in a go-kart. I don't care. There's no way he's going to beat me. And sure enough, he was quicker. I mean, I was quicker a few times, but generally overall, you're a couple tenths quicker, I'd say.
I don't know about a couple tenths. I thought we were within hundreds.
Well, our fastest time was like 5/100ths or something.
It was pretty close. It was close. That's like F1, man. That's like Norris and Piastri right there, dude. But it's close. That's in the noise.
Yeah.
But yeah, so that's cool that you got to do that.
Yeah.
Yeah, that's fun. Definitely, I'm jealous because if I had a car, I'd be out there all the time if I could. But okay, so we're going to talk about. It's funny actually because I was having a conversation with Denise's daughter earlier about what we were going to talk about today, and ClickIPO. And so I want to just spend a little bit of time going over some of the background. I've got my notes with me again, another about 17 pages worth of stuff. We're not going to go through all this word for word verbatim, but help me kind of keep us on track in the discussion. But so as far as when you started ClickIPO, um, what would be like the main mission statement? What was the impetus? Why did you feel that this was something that needed to be out there?
Because individual retail investors, let's categorize what is a retail investor. That's somebody making, 50 grand to 100, 200 grand a year. They typically have an online brokerage account where they make their own decisions if they buy stocks or sell stocks. And they had no access to the IPO market.
Right.
So we came up with a strategy and a business model that would get these investors access to IPOs, or that was our goal, our game plan.
And so, because currently, pretty much just the institutional investors, so large. Can you explain the difference between institutional versus retail investors?
Institutional is like professional money. So Warren Buffett, American funds, Putnam funds, Fidelity funds, big hedge funds. That's really professional money. So an institutional investor is somebody that has 100 million or $1 billion or several billion in an account, and those investors are they're the primary clients of the major investment banks that bring these companies public. So the way it works today is that group of investors gets 90 to 95% of the offering, and then the other 5%, 5 to 10%, typically goes to what they call a retail investor, but it's a retail investor at Morgan Stanley or Goldman Sachs I think the account minimum at Morgan Stanley or Goldman, it might be $5 or $10 million now. So if you're in an individual, so it's those retail investors are like the top. I'm not even going to
still
say
like top 1% or more.
They're even better than 1%. I'd say it's the top 0.5% or even 1/10 of 1%, because it's somebody that has $10 million in an account at Morgan Stanley. He's probably got a net worth of 50 million, maybe 100 million.
Right.
And that's who they're calling retail. So that,
Everybody
99% misses out.
Right. And so it's interesting because we did a little bit of, we discussed this a couple weeks ago just to start to educate myself. And then again, like last time I used ChatGPT, which helps educate. It's so
great.
impressed by how good it is. So can we talk about, so it wasn't always like that though. Like what happened? Can you explain like what was kind of the history on just that practice of initial public offerings, and what kind of led up to the fact that got us to where we are today, where really only institutional or that top like 0.01% of people have access to it?
Well, I think over time, over the last, I'm going to say, well, since I've been in the business, which is, call it over 25 years, I guess, over 30 years
88,
now.
right?
Yeah.
You said you started in 88.
So 30, 35 years. There is the amount of money that's invested in the market has gone from, I'm going to say in the late 80s, it was, maybe 50% of the money invested was mutual funds, institutions, hedge funds, where it was professional money, where they get all the money from somebody else and then a professional manager invests it. And that continued to take off. Even through today, it's continued to rise up, the percentage. Now it's changed a little bit in the last 5 or 6 years, as far as like trades on the exchange now. It used to be probably 5 or 6% retail investors. Now that number, depending on who you believe, is somewhere between 25 and 35% of the actual trades are individual retail investors. So that's changed because of online firms. You can open an account anywhere and there's no commission when you trade. So it's created this, anybody, an 18-year-old kid can go open an account, put $200 in it, and he can start buying.
With like Robinhood or some of
Yeah,
those
Robinhood would be one. I mean, some have been around for a long time, like E-Trade and Schwab and some others, but Robinhood is a good example of one. But the IPO market back in the 90s, there were a lot more brokers, stockbrokers, that were getting paid a commission, and they had real retail customers, like you or I might have an account. It's somebody who doesn't have a net worth of $50 million,
right?
But maybe we do okay. We would have an account, and we might get access to some of these deals. And what happened is the NASDAQ market took off in the late 90s, early 2000s, and there were lots of internet companies coming public at $10, going to 40 or 50. And when that NASDAQ market tanked, many of those companies rolled over and went to zero.
Right. I actually have a graphic that kind of shows that a little bit. Yeah. Dennis, would you mind switching back over to the presentation mode? So you and I can't see it, but we're still going to be visible in the bottom corner. of the.
See you.
So we're looking at the little snail. You and I are in there on the stream. So this was we can come back to this. This was just an overview of what how an IPO works. We can come back to that in a minute. But here, yeah, the rise and fall. This is specifically the Nasdaq Composite Index.
Yep.
But it talks about how you have some of these IPOs that just went gangbusters within a day, and then right there around
Yeah,
March
it was
2000.
a lot of it was in a 2 to 6 month period. I mean, they just got smashed. And so what happened is when they got smashed, investors complained because, hey, I bought this thing at 40, it went to 0 or $1.
Retail investors. you mean.
Retail investors.
Yeah.
So they complained, and so there were different things going on at the time. Like they had some major analysts, I can't remember which firm it is, and I'm not picking on Morgan Stanley or Goldman or Citi or any of the big ones, but it was some major analysts that would have a recommendation out on the stock to buy it, but separately they had emails within their firm saying, hey, I can't believe this thing's at this price. It's way overvalued, blah, blah, blah.
Oh, so there was.
So what happened is when small investors sued these firms, all this came out in Discovery, where analysts are saying, yeah, hey, here's my analyst report. It's a great deal. But behind the scenes, they're like, hey, this is a piece of shit. It's way overvalued.
Right.
So it created so what happened because of that, I don't want to get into the details because people will get lost if we get too far into the weeds, but because of that, there were misrepresentations on financial statements. I mean, there were some things that the banks were doing in conjunction with the analysts that were probably not a great idea. So the public was being misled. So they came up with rules and regulations about disclosure and certain things when you go public that you have to do as a company. And so it became more expensive to be public. And they also put a big onus on the CEO and the CFO of these companies. Like if it goes public and anything's wrong with the financial statements, you're criminally liable.
Right. That's all that was all brought about with the Sarbanes-Oxley.
Sarbanes-Oxley was a lot
in 2002. There's a lot of it. I
Right.
got some graphics on that too. See if we can. Key provisions, Sarbanes-Oxley, and then I've got a couple other things. But so it established that Public Company Accounting Oversight Board, PCAOB.
Yep.
It ensured auditor independence on. So what are they auditing? Just the financial statements and how they're doing their accounting?
Correct.
Yeah.
So the auditor has to be independent. He can't be hired to do other stuff for the company, really. He has to be independently the auditor. So there's some separation there. Because you had, there's some companies like Enron and, there were some other ones.
I was going to say, yeah, GPT's like the big three was Enron, WorldCom, and Tyco. Enron, WorldCom, and Tyco International, where they were specifically misrepresenting their accounting reporting and other things, and so that was one of the big pushes for Sarbanes-Oxley was those.
Yeah. So what happened is Sarbanes-Oxley came along, and then it became in the 2000s as the market got smashed. From 2002 to 2010, I'm going to say it became more expensive to get a company public. The expense of doing it to comply with all these rules, and then the CEO and CFO are further on the hook for any liability. And some people don't want to step into that liability. Hey, wait a second, if something goes wrong, I get to go to jail. I don't want to step into that.
Yeah, I had that. It's like something like they upped it from 5 to 20 years. So here were the objectives: restore public trust and confidence, improve corporate governance, enhance transparency. But then, so increased penalties, so they consider it wire and mail fraud if they're misrepresenting their company's health. It went from 5 to a 20-year
and
penalty.
It's like you can murder somebody, get 20 years.
I didn't include that, but I found a graphic that compared other penalties. Yeah,
so
like second degree
think,
murder is like 12 to 14 years.
Yeah, the intentions were good. And it is good to clean it up, and it is good to keep people honest, etc. But what happened is the expense to go public got a lot higher, and then the risk the executives are taking also got much higher. And all of this was designed. It wasn't designed to protect institutional investors or private equity. It was designed to protect small investors because when these lawsuits were coming in the 2000s because of the IPOs that went up, the analyst said this, the institutions weren't the ones primarily behind the lawsuits, because what happens is when the institution sues, they're known as smart money. Like, hey, you're super smart. You're going to tell me this internet company with no revenues and no earnings went to 40 and back to 1, and you have a hard
They
time.
would know better.
Yeah,
basically,
it's like
they would know better
you're a big boy.
versus I don't know shit
As a retail investor, I
retail.
should have had disclosure. My broker didn't tell me, and at the time they had brokers calling people and telling them, hey, this is a great IPO. I think it's going to go up and make money. And then the broker has this thing from his analyst that says, yeah, it's a great deal. He sends it to the client. Well, in disclosure later, the analyst maybe was in separate emails was saying, hey, this is a piece of crap, but it's our deal in banking. The higher this thing goes, because they're trying to get, when their deal goes from 10 to 20 or 30, everybody else out there wanting to go public wants to use that underwriter. So they have a vested interest, right? The higher and the better their deals do, then, hey, our last 6 deals, they all doubled. You want to go public through us or the guy across the street?
Interesting. Okay.
So there was kind of an incentive in there. And again, the intention behind all of this is good. But what it wound up doing is it made it way more expensive to go public. And if you're an executive at one of these companies, you had way more liability. So because of that, people shied away from going public.
Right.
Because the idea behind going public, years ago, the reason there's a public offering is you're going to let the public own a piece of your company. You're going to go public because you have a business that's growing, and hey, I need 10 million more to grow my business, or 100 million, or whatever the number is. I'm going to go to the public, I'm going to get that money, and then that money is going to help me grow my business. Right? That was the idea behind it.
And also the original investors, and when it was still private, they're basically selling off a portion of what they own. So they also reap benefits from going public.
It is, but a lot of times when you go public, and it even works this way to this day, but let's say you'd raised, I don't know, $100 million privately over the last 4 years, and you are raising another $100 million at, let's say a valuation of 500 million or whatever it is. The guys that own the $100 million at $1, when you're going public at 10, the day it goes public, they typically can't sell. They have a 6-month lockup. So it has to go public and establish kind of a price, even though they price it at 10, it opens, trades at 11 or 12. They got to kind of wait 6 months usually to sell any.
Okay.
And then if there's big shareholders in there, whoever the underwriter is will lock them up and say, hey, you own 15% of the company. You can only sell 3% of your position every quarter. So they're not going to open it up and let this guy that, he owns stock at $1, it's at 13, he can sell at 13, knock it down to 10, he can sell all the way to 8, 7, 6, who cares? He's making 6, 8, 10 times his money.
Right.
So they don't want that kind of volatility in the stock. So those early investors typically get locked up for some period of time.
Is that something that the SEC imposes, or is that the industry imposes that themselves?
Usually the underwriter does it because they don't want the deal to come out at 10 and tank, right? If it's at 10 and you and I, look, if it opens at 10 and you and I own stock at 50 cents and we can sell right away, I got a 20-to-1 return, man.
Yeah.
It's great if it goes to 15, but guess what? I'm up 20-to-1 right now.
Right.
I'm selling.
So interesting. So it's not imposed as a rule, but the industry typically does that just to keep things
right. Because the guy's going into the deal at 10. There's 10 million shares being sold at $10. Well, hey, if there's 5 million shares owned at 50 cents, and the minute it opens, this stock frees up, then institutions are going to say, and smart retail investors would say, hey, I'm not investing in that because there's too much cheap stocks going to be for sale right away. It's going to kill the price.
Okay. Interesting.
So that's kind of how it works.
So I did.
But anyhow, what we're talking about is what changed because of these dynamics of it's harder to go public, kind of a crappier market, risk of going public. There were a lot less offerings between 2002 and 2012, I would say.
Right, because a lot of companies, their executives just didn't want to.
They didn't want to do it. So what happened is in the private sector became very, very big in funding these companies. So the top level companies were getting private sector funding, so they didn't really have to go public. So they would get money in the private sector to 100 million. Then the valuation would go to 300 million a year later. They'd get another 30 million. Mm-hmm. And then eventually these companies, people that are invested in these companies, you either have to sell the whole thing and go public through an M&A. You either have to sell it to another private company that would buy in an M&A transaction, somebody would buy it, or If you don't do that, then you have to go public. And so what happens is the valuation goes way up over the period of 5 or 10 years. You don't need to go public because you're trying to get capital to raise money to grow your business. You're just trying to get public, maybe raise a little money, but you got all these early investors that want out, and that's your only exit.
Is going public.
Is going public.
Or a merger and
Or a
acquisition.
merger. Yeah, one of the two. So what happened in that time from 02 to 012 and then 012 on, all these small investors that sued, a lot of them won. And over time, when you open up a brokerage account, like if you have a brokerage account anywhere, there's an arbitration agreement in there. So if you have a dispute with your broker, you got to go to arbitration. It doesn't go to like the regular court system. So I don't know what the stats are today, but it used to be individual retail investors, when they sue a firm, a broker dealer, they're winning like 65, 70% of the time. So retail investors win their cases. Institutional doesn't work that way. It's probably less than 20%, so way less.
Because they can't argue that they didn't know any better.
They can't argue, I'm dumb, I didn't know better. But when a retail investor argues that, so because that happened, what's happened is, I'm going to say, back in the 80s and 90s, it might have been 60%, 50, 60% institutional and 30, 40% retail. That's swung all the way now where it's 95-10, because over the last 20 years, the major firms that bring all these companies public, they don't have small retail investors because it's too risky. They're small, we can't make any money. If I give Eric some stock and it tanks, he's going to sue me, he's probably going to win. It's like, we don't want anything to do with that.
So I want to come back to, because has there been any discussion as far as like tort reform to, I guess you said that nowadays when you open an account with an investment firm, the small print has you go to arbitration. So is that how they've addressed? So
No, it's always been that way. You'd always go to arbitration, but
they're still winning in arbitration.
But in arbitration, the small investors are winning. They're winning 70% of the time when they take something.
So is anyone discussing like some kind of tort reform to prevent that from occurring?
Has
that ever been a part of the discussion?
The two regulatory bodies are the Securities and Exchange Commission, and it's called FINRA, which is it stands for Financial Regulatory Authority, I think. So FINRA regulates all the BDs. And then the SEC, is kind of they oversee FINRA and they oversee their enforcement. The whole mantra of FINRA and the SEC is protecting retail investors. So they're not going to let up on.
They're not going to impose and make it more difficult to sue somebody.
Correct. They're going to give the investor the benefit of the doubt.
Yeah.
And so what's happened, so partly because of that, brokerage firms and then the other thing is because Robinhood came along and other reasons, there's zero commission in the online world. So now a brokerage firm doesn't want to have a broker that has retail clients, because if I tell you, hey, buy this stock, it goes down, and you sue me, you're probably going to win. So it eliminated that whole thing. And where these investors went, if they're super high net worth, they have an account at Morgan Stanley, Citi, or Goldman. Or if they're super high net worth, maybe they have an RIA or a financial advisor that puts them into super safe stuff and charges them 1% a year or whatever.
Mm-hmm.
And then the individual investors that actually still want to be in this market and still want to buy IPOs or other products, they're at these online firms that you can open an account for $500 or probably $100 now, most firms. And you can buy and sell stocks and it's zero commission. So there is a massive influx of people going into these online firms, both in the US and globally. And what we've seen globally with our model is that many foreign BDs, they want access to unique products like IPOs. So like, hey, how do we get those?
Mm-hmm.
That's why they partner with us to try to get access to these things. But there's a massive market out there.
So, but currently right now with with E-Trade or with Robinhood, an investor like myself or average person those currently don't offer IPO securities.
They don't, Robinhood went public, and a portion of their IPO, they did it internally. Goldman Sachs took them public. But firms like Robinhood, SoFi dabbled in the public markets, but basically nobody has access. Because the major investment banks, the way they work is an IPO has a lot of commission in it, right? I mean, we get paid 3% on anything we do in an IPO. So whatever we place, and we got to share that with our partners, where our model works. But the major banks, they try to price these deals at less than what they're really worth. So they try to price it at 10, and they want to keep all the commission. And then when it opens at 12, they just created, $2 in alpha for all their best clients. So they want to take the deal, underprice it a little, give it to their best clients, and then they make money off of it literally right away in some cases. Not all IPOs go up. And that's their model. So they have no incentive the major banks who control distribution, they have no incentive, to allocate shares to Click and our network of online broker-dealers.
Or for any of their, if they do have retail clients, offer it to them.
Well, if they do have high net worth retail and
High
clients,
net worth.
so here's the thing: to go
0.1%.
depending on if you go NASDAQ or New York Stock Exchange, you need 300 to 400 shareholders. So a lot of times, they might have, they're raising 100 million. There may be 6 institutions that take 10 million each. So there's 60 million. Then of the other 40, they spread 35 of it out amongst 25 other institutions. Now you got 50 people in it. So then they got that last $5 million or $2 million. They go put that in their high net worth retail. They go put that in 500 hands.
Right.
That's how they get to the shareholder minimums.
Gotcha. Okay. I didn't realize that there was a shareholder minimum.
Yeah, you have to have so many shareholders to be considered a public company. So it's 300 for some deals on NASDAQ and 400 on New York. There's different rules around it.
But it's still low enough where they can offer it only to the high net worth retail investors.
And these rules were written, 40, 50 years ago, right? This was before, that's when a broker was calling and getting a guy to buy it. It's like in NASDAQ or New York, it's like, hey, we got to have so many shareholders in this, because if you don't have enough shareholders, the stock won't be liquid. It'll trade 1,000 shares a day, and then a big seller or buy order comes in and it goes up or down $1. I mean, it becomes, so they got to have more shareholders, but they've never changed those rules, which is one of the things we sent to NASDAQ and said, hey, you should change the rules, because some of the smaller deals that go public with limited shareholders, there's tons of volatility in these things. I mean, they go public at 6, move up to 10 or 11, 3 days later it goes to 3.5. And it's because it's not well distributed. The shares are in the hands of a few people, so they can run the price up, or if they decide to sell, it goes down quickly. But if you put it in, we proposed to NASDAQ, hey, make it a 2,000 shareholder minimum. I mean, come on, in the online world with everybody out there with a smartphone that has an account.
So when you propose that to them, are they willing to listen?
No, they don't even respond.
Because there's nothing.
There's
nothing.
I don't even know. I don't think. I don't really think NASDAQ wants to do small public offerings. I mean, they don't. They want to do the big deals that come through, Morgan Stanley, Goldman, Citi. But I mean, they don't want to do small offerings, because these small offerings are earlier stage companies.
Mm-hmm.
They're not well distributed. They tend to be. They tend to be very volatile. And NASDAQ actually just came up with something they want comments on here like a week ago. I found out about it, but they're going to change the minimum amount of money you have to raise for an IPO is going to be 15 million in about 6 months. So there are many, many offerings where companies are raising 10 million or 5 million.
So why would the exchange increase?
Because I think what they're trying to do is, if you have to raise 15 million, you have to get more anchor investors involved with this. So you're going to have some smarter money in these offerings, and they're going to vet these deals better. And if you're raising 15 million, it tends to be a company that's a little further along in order to have to use 15 million.
Yeah.
So that's why they're changing it. But it's the market. The Wilshire 5,000 so you have the S&P 100, S&P 500, you've got the NASDAQ, right? Okay, so the S&P 100 is the top 100 stocks, S&P 500 top 500 stocks, right?
Yeah.
The Wilshire 5,000, there's 32 or 3,300 publicly traded stocks now. In the late 90s, I think there were 6,000.
And so that reduction is because of the fact of some of these more severe penalties.
Penalties, more regulations, more expensive to be public, and then right now you have everybody chasing the same stock. So that's why the Magnificent Seven, the top 7 companies, people are putting money in. It's Tesla, Microsoft, Nvidia, Apple, Amazon, Netflix. I mean, that's where so it's a very narrow market. I mean, it's not
Mm-hmm.
It isn't broad based, and there's only 3,000 stocks out there now, and that number is shrinking every year.
Is it shrinking? Is it because of so does it go back to like SOX and some of the penalties that have been imposed as well as so those two things, is it the threat of these more significant penalties if you're not meeting or if you're not compliant to the SOX requirements, as well as then shit, I think that cough medicine's kicking in.
Got a good combo going there.
So you have these more severe penalties, as well as then just the cost of being compliant. And actually, I had a graphic that talked about that too. It was like SOX costs pile up by location. So I think, so this is from Accounting Today, and I think it's for brokerage firms depending on how many different offices they have. But it just showed like the larger you are with respect to interacting with investors, the more, it's the more costs your sunk costs just in meeting your SOX requirements.
They just go up. So it's really expensive. The penalties are pretty draconian.
Yeah.
So less people go public. And it's like, and so what happens is, so all of this was designed to protect small investors and make sure there's a level playing field. But what winds up happening is now you have less and less companies going public. So, and here's the other thing that happens. Give you an example. Amazon went public in 96 or 7.
Yeah, that was on that earlier graphic.
$600 million market cap. Uber went public, I think it was 50 billion. So now how did Uber get to a $50 billion market cap? Well, they grew in the private sector. They probably had 7 or 8 rounds of financing. Well, their first round was at, the seed round was at, 50 million. Then they did a round at 200. Then they raised another 100 million at $1 billion, right? And they did, a bunch of rounds. So who did that round? Well, venture capital did. Okay, well, who's venture capital? Sequoia, Benchmark, and all these firms that invest and take big risk in these early stage deals. I mean, these venture guys, they lose on a lot of deals too. They're not like, if they get 3 out of 10 that works and 2 are home runs, they're up 30-40% for the year. But where does the venture capitalist get his money? From foundations, from people with huge money, super high net worth people say, hey, Sequoia, you guys are Benchmark, you guys are smart guys. Here's 50 million of my $1 billion of net worth. So what happens is all the people that are worth a ton of money are the ones that all get the growth.
They all get access.
Right.
Yeah.
So how does the public get? Well, the public, you got to, first of all, to be in that, you got to have a lot of money. Second of all, you got to be an accredited investor to invest in a venture fund. That means you have to have $1 million net worth, excluding your residence, and or make $250 a year. So it excludes a lot of people.
Where are those SEC rules? Where do those rules come in? They're SEC rules.
So anyhow, so my point is, if you got these, like Amazon went public at a $600 million market cap. I don't even know what the market cap is, $1 trillion or whatever it is now. It went public, and the public could actually participate in the growth of that company because it went public early in its growth cycle.
Right.
Now these guys are staying private and they're going public way later so the public is missing out.
Right.
It's like these rules and regulations were designed to protect the public, but it's had the opposite effect of keeping them out of the potential growth.
It's made it so scary for the people that are managing and bringing these companies public that they've just stayed. They've pulled it back so that they don't.
And the major firms, to that risk. They don't even, if you've got a net worth of 50 million, you have 5 million in an account at Morgan Stanley, you do 100 grand of an IPO at Morgan, it doesn't work out. If you try to arbitrate that, even though you're an individual retail investor, the arbitration panel, hey, what's your net worth? 50 million. How many risky investments have you done? Oh, here's 100. Well, sorry, you're big boy.
Right.
Unless there's something blatantly illegal. If the broker told you thought it'd go up, but it didn't, too bad.
So do you have
the big firms don't want small investors because the poor guy, hey, I make 100 grand a year. I gave these guys 100 grand of my hard saved money. He should have told me it went down. The arbitrators are going to feel bad for him.
Yeah, we had talked about that before, as far as what are how is this like negative feedback loop resulted in the current situation? Because like you said, and it seems to make sense on paper that sure, we want to put these regulations in place to protect the average people.
Yeah.
But as a result of that, now it's made it more difficult for the average person to
Correct.
participate. So I've got a few, I looked at, because you had mentioned some other some other countries, foreign countries approach this from a different way. So I do have some notes on how other countries try to ensure retail access. But before we go there, do you have any other ideas as far as, so I mentioned like tort reform or something. What other solutions do you have in mind to try to, like, how do we still protect and make sure that people aren't, those bad behaviors that led up to Sarbanes-Oxley, how we're still preventing those from occurring, but yet not scare people away from including retail investors? Like, what are some of the ideas?
The difference is, I'm going to say pre-Sarbanes-Oxley, okay, there weren't really online brokerage accounts. So individual retail investors had a broker in the 80s and 90s. And that broker called and said, hey, buy this IPO, or when public attendance at 20, buy it, I think it's going to 30. So there was a broker attached to that.
Yeah.
The difference now is where all those individual investors are, they're all at online firms, and online firms do not make recommendations. They don't say, hey, you should buy Coke, you should buy Tesla, you should buy this IPO, you should buy that. Everything's unsolicited.
They just provide
access. Hey,
Gotcha.
You want to buy Tesla? Go ahead. You want to buy Coke? You got an IPO? You want to buy it? Go ahead. Here's the prospectus. So they're now not recommending anything like was going on before Sarbanes-Oxley. It was all broker recommendations.
Right. So someone, they can just say, hey, we just gave you the ability to buy this. It was your own decision.
Correct. And if you look at arbitration cases and things like that, and I researched it because I was curious when we were starting up ClickIPO, and we're like, and the way our model works is we have a technology platform, and we're a licensed broker dealer, and we have agreements with, I don't know, 55 underwriters probably. We've placed 420 offerings, probably over 300 IPOs, and then some follow-ons and SPACs and other types in the last 4 or 5 years. But we let a online broker dealer use our platform, which they integrate it through an API, and it's basically like our front end within their platform. So if you go into TradeStation or Webull or Futu or some of the firms we work with, you go in there, you look at their IPO section. There's 3 IPOs listed. It's us behind the scenes.
You're in the back end. You're providing the back end.
Yeah, I'm providing the back end, so somebody can look at it and say, hey, ABC Pharmaceutical, click on it, place an order, and that order routes through to us. They don't even know we exist. And then we aggregate those orders, send it to the underwriter allocates to us, and we reallocate.
So just by the fact that, does that provide the solution then, the online accounts?
It's a lot better because the online broker dealers, nowhere have I seen, and I looked at this when we rolled out our model, like, hey, our online broker dealer is getting sued because an investor bought something and it went down in value, whether it's an IPO, a regular stock, or whatever. The answer is no. I've never been able to find anything in arbitration where, hey, the online BD should have said, no, you shouldn't buy this stock for whatever reason. They're just showing it to them, and it's all unsolicited. They're not ever talking to the guy or gal, right, that buys it. So there's a lot less, there's less risk for everybody when the end individual customer is making their own decision.
Right.
So
I guess part of the problem has been somewhat solved by that fact.
It's solved by that, but the problem is the major banks, and I was just in New York, and I met with Citi, I met with RBC, I met with BMO. Who else did I meet with? Anyhow, some of the major banks. And, they're like, well, we got some retail, and, we get the deals done institutionally. And
so actually getting an allocation of those shares available to retail
investors. Because they can get it done without having us. Well, why should I share this commission with you? And then my argument would be, well, first of all, it's a public offering. It's not an institutional private offering.
Right.
It says public. The public should have access. And I ask these major banks the same question. Well, wait a second. After it goes public, like Reddit goes public, right? It opens up, trades at a premium. Well, retail investors came after that deal. Is that okay that they buy? Oh, yeah, but they can buy it in the after. Oh, okay. So it's okay for them to buy it in the aftermarket, but they can't have the IPO. They can't buy it at 30 when it opens at 34, but they can buy it at 34 from the guys that bought it at 30. It's like It's so unfair.
So basically where we're at is all the stuff that led up to 2002, a lot of the banks who actually work with the new issuers. So you have a new company that wants to go IPO. They work with a bank in order to manage that, go through all of the SEC requirements to get everything in place in order to do that. The post 2002 and the dot-com crash, a lot of the access has been pulled back from the retail investors, and the banks really have the authority to decide whether or not they're going to offer it.
Yeah, the major banks think that it's their shares to hand out to whoever they want to hand it out to. It's really not. It's really the issuer's shares. Like there was a deal a couple years ago called Allbirds. It's a shoe company. You guys have probably seen Allbirds, right?
What is it?
Allbirds, casual shoe company. Oh, you're not ringing a bell. Does it ring a bell with you? Oh, okay, all right.
I wear Ultras and Vans.
Okay, well, it's kind of higher end than Vans, is what
Okay.
I'm saying.
What's it called?
Allbirds?
Allbirds.
Well,
Anyhow.
Allbirds, if any of you are watching this,
Bill has
we
Allbirds.
just
I know you do.
we just gave you a plug, so maybe like and
Anyhow.
subscribe, please.
There's a three.
Allbirds, like and subscribe.
Do they
It's-
look like any other shoes?
They're kind of like fancy casual shoes, is the way I would describe
Okay,
them.
fancy. Okay.
Yeah, you guys can look at. But anyhow,
I'll look at it if I ever actually have to go back to an office job where I've got to like be presentable. Maybe I'll consider wearing those because I do like wearing like skate shoes. Like I'll wear all black skate shoes instead of dress shoes to work because they look. I'm not wearing any right now. I'm wearing socks, but they look nice enough that I can wear them to the office. And
Yeah.
yeah.
no, they're getting better. I mean, look at.
Are you
these.
wearing them right now?
No, I'm not. I
Oh,
got
those are
Nikes
Nikes.
on, but there's so many of these shoes. You know, they're kind of dressy.
Allbirds.
Yeah.
They're not basketball shoes, really. They're kind of dressy shoes.
They're kind of yeah. You know what's funny? Sorry, totally different subject, but did you realize, I've realized it because I was on the East Coast and I was in a sailing supply store and they had boat shoes. Dude, boat shoes are Vans. They have the non-marking.
You know what made Vans? Vans was struggling big time. Was close to going under. Do you know what made Vans?
No.
Do you ever see the movie Fast Times at Ridgemont High?
Yeah.
Okay, well, Fast Times at Ridgemont High, they took that movie, they wanted to get a major release out of it. Nobody wanted the movie, so they had to go to like little janky places around the country and get them to play the movie, and it caught fire, and then the movie took off and has become a classic, right? But the major studios the major distributors didn't want anything to do with it. But in that movie, Spicoli, he's wearing Vans. And because he was wearing Vans in that movie, that's where that company
Really?
took off.
I didn't know
That's
that.
why. It's a crazy
Interesting.
story. Anyhow, so Allbirds, Morgan Stanley's doing a $300 million deal.
Yeah.
They're based in New Zealand. We know the company. They like our distribution to retail investors. So they're like, hey, we want to do a chunk of the deal through Click. Okay, great.
So wait, real quick. So they're a New Zealand company, but they're listed on
Yeah,
the U.S.
they're going
stock
public in
exchange?
the U.S. stock. And a lot of companies do that. Many foreign companies try to list in the U.S. because it's the best market. So I talked to Morgan Stanley and get an agreement with them. I was like, hey, we know Allbirds. They said they're talking to you guys. Yep. Well, we want to do a piece of it, And so I told Allbirds, you're going to have to tell Morgan Stanley to give us a piece of this deal. Otherwise, they're not going to do it because it's way oversubscribed. I think it was priced at $16 or something like that. So we got a chunk of the deal, which for us at the time, I can't remember how much exactly we got, maybe $10 million, which was a good piece for us at the time, a couple years ago. 16 opens at 18, went to 20. I think it went as high as 28 or 30. But there was no way Morgan Stanley would have ever given us, because we
Even
took
10
$10 million
million.
worth of stock at 16 that was worth 20 3 days later, that they could have given to some of their clients. So they would have never done it unless the issuer.
The issuer.
So where we're going is, Click is building a massive global distribution pipe, and we're probably going to have maybe 50 million investors on it before the end of this year. And so that is a mass. So if you're an issuer going public and you want to expose your brand to 50 million people, maybe give them a piece of the IPO. They may buy the IPO, maybe they'll buy it in the aftermarket, maybe they'll buy it 6 months from now, but they're going to know what your brand is, right? It's 50, like what would you spend as a company to get your brand in front of 50 million people?
Right.
And we'll do that because at the IPO, that's the one time when you're going public where you stand out. You're not one of 3,000 companies out there. Hey, it's my public day. I build software, I sell aspirin. I've got a cure for cancer, whatever it is. And that's the one time. That's a huge value proposition we can bring to the issuer. So, but the major investment banks aren't going to tell the issuer, hey, this Click has a great, they got a global distribution pipe of all these investors around the world. Hey, we're raising 100 million. I think we should give 50 million of it and the 3% commission to this other firm.
Right, because they're not.
We'll never do that.
There's no.
Why do they want to give away 1.5 million in commission?
Yeah, there's no
No, we'll
motivation.
keep it
There's no
ourselves
motivation for
because
them to do that.
this is the way we've always done it. There's institutions. You don't know what retail investors are going to do with the stock.
Right.
There'll be a whole host of reasons, but basically, the model at the major investment banks, the reason IPOs are so important to them, first of all, there's a lot of commission in it. Second of all, they try to underprice it so it goes up. So they create alpha for clients. And then those clients stay with that firm and they do lots of other business through that firm. At Morgan Stanley, or not Morgan, I'll just say in general, major investment banks, they keep track of the commission you generate. And a lot of times, based on who you are and how much other business you do at the firm, that affects how much IPO allocation you get. So they're really kind of using the issuer and the IPO allocation to help their other businesses. They're saying, hey, Eric, listen, your $10 million account, why don't you put 10 million more in, and guess what? I'll give you every IPO we have, I'll give you a piece of it because you're special. Well, because you got a lot of money, and then that other money you put in the account, you're going to do other stuff with, and they're going to charge you a commission with. So it's a very, very lucrative business for the major investment banks. It's about the banks, their clients, how much money they can make, how much their client. It's not really about the issuer. And again, I'm not saying because some investment bank is going to watch this
and it's still, I guess, heavily. It's like tipping the scales towards people who will already have a high net worth, who have access to that conversation even. And so to go back to it, and the beers are catching up to me. But so you have the banks that manage all the IPOs and have the authority, even though the issuers own it. You're saying the issuer would have to come to whomever they've partnered with to manage and to bring themselves public. The issuer at this point would have to require them to offer a certain amount to retail investors, because otherwise there's no incentive for them to do it, because they know they'll be able to make just as much money with institutional investors or high net worth retail, the high value retail investors. There's no motivation for them to go any further. All right. But what you're saying though is that from the issuer's perspective, the issuer being the company going public, that hey, it's almost free marketing of their product and service, because you're going to open up this IPO to globally. Correct. So you're going to have, just by virtue of offering it to the average everyday investor, it's free marketing.
Companies spend, what do you spend to get your product in front of 50 million people, directly in front of them? Like an investor that is going to look at it because it's an IPO, might actually invest in your company. And there's all kinds of studies about, if people buy Nike shoes, they buy Nike stock. If they buy Nike stock, they're looking for shoes. Well, they're not going to buy Vans. They're going to buy Nikes, right?
That's like one of Warren Buffett's main bits of advice or actually it wasn't. It was, who was that lady?
You go shop at Home Depot, you're going to buy Home Depot stock.
Yeah, like the number one
in
individual investor, that lady from New York, who was she just killed everybody over the course of her lifetime. I can't remember her name, but that was her main bit of investment advice, is just invest in companies that you believe in. Yeah. That you would buy their products.
That's what people do. You go buy, and that's what I would say to a company going public. I'm like, if we were further along in our life cycle, when somebody like Allbirds comes along, I would say, hey, look, let's put this in the hands of 100,000 people, because those 100,000 people at all in $100 each or $500 each, whatever they own. When they go to buy shoes or hey, I got a piece of this Allbirds deal at 16, it's trading at 21. I'm up $500 on it. Hey, I got to buy shoes. I'm buying shoes for my kids I'm going to look at Allbirds online. I own stock in this company, man.
Right.
This company was nice enough to give me a piece of this. Hey, guess what? I'm going to buy their shoes.
That's a good point, because it's the same way that influencers work online, where it's all word of mouth. right?
Yeah.
And it's who you're going to recommend this to other people that you know who may be buying this product or service, and so that makes a lot of sense. That by getting more people excited about it, they're going to talk to other people who are also
They're going to
consumers.
tell other people, other consumers. They may buy the product. They may tell the friend about it. There's all. It's like it's a lot bigger long term benefit. And look, the world is changing. I mean, 15 years ago, I'd go to a board meeting because as an investment banker, I'd sit in a board meeting. There'd be 7 white guys on the board. Okay. Now NASDAQ has rules about, you have to have either 2 or 3 people that are minorities. So you have to have females, you have to have people of color. You can't, it's like the world is becoming more democratic. It's becoming more inclusive. And and a lot of these CEOs of these companies that are coming public, they're younger than me. I just turned 61, right? So they're probably, a lot of them are in their 30s or 40s, right? A lot of them are younger than 50, and it's a much different demographic.
They have that expectation.
Than I was a kid. They when I was that age, I think generally speaking, I wasn't thinking about the environment. I wasn't really thinking about other people. I was thinking about, hey, how do I make money, and how do I do that? It was much more of a capitalistic mindset, I would say. And now I think more people, for a lot of different reasons, and we can get, that's a whole nother topic, but they want to include, hey, I want everybody in my IPO. I don't want to contribute to global warming. I want to be fair. I want to hire people, whether they're female, black, white, gay, straight, who cares? Right? I think we fit into that mantra. We're talking to a firm, minority-owned firm in New York called Independence Point. It's female-owned, and they get into some of these IPOs just because they're a minority-owned firm. Because they're a minority-owned firm, they get into some of these IPOs, but they get in, they don't get a lot of allocation. It's almost like it's almost like a checkbox, because the issuer going public or the major investment bank underwriting is like, I'll give some to a minority. Hey, we gave some to a minority-owned firm. We put them on the cover. Well, it's $100 million deal, and they gave them $100,000. It's like
That's interesting.
Check a box.
So it's interesting that there currently is no SEC rule, or there's no legal requirements for. And I'm going to use the word tranche. I learned that term after talking tranche.
Yeah.
Tranche. Okay, tranche.
TRAUNCH.
Tranche.
I think.
So I learned that. I'm going to come back to that. I learned
spell
that as I
check,
was
I
doing
don't
my
know.
Chat GPT research to talk to Scott here. So tranche. So there's currently no SEC requirements or legal requirements to offer percentage, like dual tranches or multi-segmented tranches to different types of investors within the U.S. But it's interesting that there isn't, when you mention as far as like offering or including minority owned or women owned businesses, because I do know, and actually I'm here in the next few months might have someone on to talk about this. So within DOD, so the federal acquisition regulations, there are typically requirements when the government like gives Northrop Grumman a large defense contract. They have requirements in those contracts to include a certain percentage of small minority-owned businesses or women-owned businesses. So it's interesting to think about, if there were legislation or SEC regulations regarding how you organize these tranches to say a certain percentage should go to women-owned firms or minority-owned firms.
Well, either that, or in other countries like Korea, we have 2 partners in Korea. Yuant and NHIS are 2 of our partners, and we've got a few others over there. They're getting access to U.S. IPOs through us. Now, in Korea, I believe it's 30% of every deal has to go to retail investors. That's not professional money.
Right.
And they're like, and one of the reasons they did it, they're like, oh, we can't believe it's not that way in the U.S. because otherwise, they just, that's what they're doing.
Well, the current situation is what it is.
It is.
Otherwise,
they're cutting it out. So you either have to go and you have to get, some regulations changed or passed.
Yeah. I was reading that about so when we talked about this, I asked GPT, compare U.S. regulations to other countries regarding access to retail or access for retail investors to IPOs. And there is kind of everyone does it differently. But like in the UK, what do they say? They've got like UK IPOs are allocated shares through. They have a platform called excuse me, Primary Bid.
Oh yeah, I know.
Is that one of your competitors?
Not really a competitor, but they're trying to do the same thing we are. They're trying to get, and again, their model may have changed a little bit, but they're trying to get access to IPOs to individual retail investors. So they're kind of working with the London Exchange over there.
Mm-hmm.
But in order to do it, the rules are different. You have to download their app. You have to do it through their app. And then once you get the shares have to be deposited in a brokerage account, at another brokerage account, because Primary Bid actually isn't a broker over there. So they have a little
It's
bit.
just kind of like a front end to get into.
It's a front end, but it's painful to transfer the shares. It can happen in a day. It could be a week or two. It could get hung up. So in the meantime, the stock's going up or down. If you want to sell it, you can't do it.
Interesting.
They were talking about coming to the U.S. And I don't like. They're championing their mantra is, hey, retail investors should get this equal access. It's the same thing we're doing. They're doing it a little bit different way. I personally hope they're super successful there or in the U.S. because it would open up the market to individual investors, which is what we're trying to do.
Right. I saw so one of the things that I found. So India, for example, by law, they require a reserve of 35% of shares for retail investors. And then they actually define like what's a retail investor. So
Right.
They get around them playing games
Right.
and offering it only to the high end retail investors. They say, retail must apply for shares worth less than $2,400 total. So it's like real small investors.
Yeah. So you put in an order for $2,000. You get a lot of, you have a zillion people. If you
so by law, they're like, we're going to force 35%. Are going to be very small.
Right. So if you're worth $1 billion and make $50 million a year, you get to put your $2,000
in. Yeah.
That's a great idea.
I do think it's a good idea.
Yeah.
Yeah. So I mean, I definitely from my opinion, I feel like there's definitely a balance. I think it sounds like I'm interested. I want to ask you how do you approach? So what you've been talking about is approaching the companies, the issuers, and convincing them that it makes sense for them to then require of the banks who are taking them public, to allocate a certain percentage, right? And so I want to come back and ask you what are some of your ideas as far as how do you actually do that? But at the same time, I feel like there's probably room for us to, if the free market were going to do it, if it made sense and the free market were going to do it, it would have already been in place.
Not necessarily.
But, well, I mean, I guess some of the regulations drove them away.
There's a lawsuit going on in NASCAR right now.
I've read a little bit about that,
Okay.
but I don't know.
Well,
the
France
details.
family is in the major investment banks in New York, Goldman Sachs, Goldman Morgan, JP Morgan. I mean, these are very powerful entities. It's like trying to sell stuff in the garment district in New York. There's somebody's taking a piece of the action. If you know what I mean.
Okay.
They're very, very powerful. I mean, those major banks, man, they are powerful. And they don't want to give up. And if I were in their shoes, I wouldn't want to give it up either.
So I guess, but that's what I mean, right? Is they currently have the power to limit access to retail investors. Even though there may be, like you were saying, there is an incentive for issuers to have a large pool of people who access to their IPO, but the banks currently have such a stranglehold on the process, they can thwart that unless the issuer says, no, I absolutely require you, or I'm going to go somewhere else. Right, because that's what they have. That's the leverage they have. An issuer can say, I want 30. I'm going to match India's approach. I want 35% offered to retail investors at no greater than $2,500. And if the bank says, no, we're not going to do that, then they say, fine, we're going to walk and go to somebody who will. Right. So that's the only.
Yeah.
Right. But I guess my point on the free market working is currently, unless you convince issuers to do it, it's not happening. Right. So I'm in my mind, I see there's some, we could, and that's what I want to hear your thoughts on. How do we convince more issuers to start to impose that on the banks that are taking them public? But then also so far it hasn't been happening. So from a regulatory standpoint, can we start to nudge them in that direction by implementing some of these ideas that other countries have been doing via regulation?
Well, it may be. I've got a meeting coming up, probably the end of February with the SEC.
I was going to ask you about that.
So, and we've got, one of the guys on our advisory board is a guy named John Ashcroft, who's a former Attorney General under Bush years ago. He's a great guy. He supported us, and the reason
you need to say that louder. You have a personal relationship with John Ashcroft. Yes. Anybody who's been reading the news in the last 20 years knows John Ashcroft. Yeah. So that's a big deal.
Fantastic guy, and he's backed us. He's backed us and a group of his guys. And the reason he backed us is because he thinks that the people that get all the access to growth don't need it, and the people that need access to growth can't get it. And we can help solve that problem because he thinks everybody in America should be able to participate in the corporate growth of these entities. And the way the system works today, whether it's rules and regulation or just the way it works, they don't get to participate if you're low net worth. You don't have that opportunity. So that's why he's backing us. But yeah, we're gonna meet with, the SEC and a few others to see if we can, figure out what we can do. I mean, maybe there's a regulatory change, maybe there's a requirement.
Is that something that the SEC has the authority and the ability to implement and impose?
They'd have to change the rules.
Or would it have to be legislative, where Congress would have to actually pass the law that they're now?
It'd probably be stiffer if Congress passes the law. I think that would probably be a better way to go if you got Congress to pass the law that, hey, here's how it works.
But the SEC does have the authority to impose that rule should they be convinced to do so?
They could. They could impose it. And they could influence it. I mean, there's a lot of things they could do.
So me living here in Chandler, Arizona, actually, right now we're in Biltmore, Studio D, but I live in Chandler. So if I were to call up Andy Biggs, who's my representative in Congress, and say, hey, I really want you to either bring this to whatever committee, what committee would even discuss this in Congress,
No, I'm not really sure. I'm not sure which committee would discuss it.
So for anyone watching, I'll do some research and post that on the channel. Like, if you're interested in, shooting an email to your congressman or congressperson, saying this is important to me, I'll figure out what committee would have to actually be debating the legislation.
Well,
and drafting it.
Another guy in our advisory board is a guy named David Wield. He actually owns a brokerage firm called Wield and Company, but David wrote parts of the Jobs Act. If you look in his bio on Wikipedia, it says father of the Jobs Act.
David Wield?
David Wield. W-I-E-L-D or E-I-L-D. Yeah, he's on our advisory board too. He's all for what we're doing too. So he'll be involved when we go back and sit down and meet. We met with the SEC a few years ago, but they weren't ready to be very helpful. But now things are changing.
What's changed? Why are they more willing to listen to you
now? Because we've got better connections with the party in power now. Yes. Before it was very, just like sometimes, and again, I'm not knocking or touting the SEC or prior or post anything of that. Just sometimes timing isn't right, to make changes. So we'll see. I mean, we'll see where it'll go. I think it's a long haul to get legislative changes to do this. But it would be ideal for us. If they came out and said, hey, 35% of every retail deal has to go to retail investors.
By law, you mean, versus just SEC imposing the rule?
SEC imposing the rule, it'll get challenged, so if they can do it by law.
It'd be, yeah. So what are you actually what are the main points that you're taking to the SEC to try to convince them to do?
Just trying to figure out a way we can change the system. We could change regulatory requirements. They don't we went to NASDAQ and we went to the NYSE. There's really, if you're going public in the US, there's two games in town, New York Stock Exchange or NASDAQ. We went to both of them. And if one of the things they could do is say, hey, you got to have I'm like, have 5,000 shareholders, make that the minimum. Well, the major banks, there's no way they can get 5,000. Make it 10,000. Like we could get, we've put 15,000 people into a deal. We could put 50,000 into a deal in a week.
Oh, so that would be a simple solution. Just require the number
Require
of
X
people.
amount of shareholders in the deal.
Interesting. Yeah.
And that would force distribution.
them to
That's
s-
one way to do it. But here's the
Interesting.
problem. NASDAQ, so a company's going to go public. Do I list on NASDAQ or do I list on the New York Stock Exchange? So they compete with each other, right? So NASDAQ's not going to come out with this rule because the major banks are going to say, hey,
They'll just go to the other one.
forget you, I'm going to the New York. Or if the New York came out with a rule like that, man, forget it. We'll go to NASDAQ.
Okay. So again, there's that whole, is the market providing something that there's a need for it currently? So it seems like there's some there's a need for, either the SEC or Congress to start to nudge them in a certain direction, because otherwise,
Well, the SEC could do it, NASDAQ could do it, the New York
Right.
Stock Exchange could do it.
well,
But-
you're saying, but the NASDAQ and New York Stock Exchange, there's no motivation for them to do it because they'll
economically,
lose.
there's not, but the way the world is going, like I say, NASDAQ, you could have 7 board members. It used to be all 7 white guys. Well, they
Oh.
came up with a rule that said, hey, you have to have minorities.
I see. Okay.
You have to have at least, I think it's 2 minorities. So it's female, somebody of color.
So you're saying, so
I'm s-
basically what you're saying, the issuers themselves, it's going back to the issuers now requiring that this
Well,
occur?
it's the issuers, but I think over time there's going to be a tipping point where NASDAQ is going to be under enough pressure, or the New York Stock Exchange or the SEC to say, hey, we got to step in and do what's right here.
Yeah.
We got to do the right thing. I don't think it's going to be the major investment banks that are going to be like, hey, we're
Well,
born again Christians. And guess what?
Yeah.
We're going to give half our deals to retail
Right.
because it's the right thing to do.
Right.
No, they're not the ones. The SEC could do it. NASDAQ could do it. Congress could do it. I mean, the way for us right now is to work with the issuer directly, but it's
How do you do that? How do you approach?
you got to reach out and get to the issuer. Like when SpaceX goes public, I got a buddy of mine that knows Musk a little bit and he knows his brother. Hopefully we'll get in there. And Musk hates the major. If I was sitting there talking to Musk about this, he'd be like, yeah,
Is he going to impose a minimum requirement, a tranche of
I don't know.
50%?
We have to
retail?
get to him first and say, hey, here's our value proposition. We got to get to somebody like a high profile name like SpaceX,
Mhm.
right? Or some other high profile name where they do a big chunk of the deal through us and the deal comes out, goes up and works basically. And then we can go advertise that to everybody out there. Hey, we'll do a big piece of your deal.
So you right now,
That's the
though,
capitalist way to get there without regulatory help.
So you're in a position where you just need to have the manpower to go out and talk to enough
Issuers.
currently private companies who are considering going public and have this conversation with
Correct,
them.
but these major companies like the SpaceXs, the Reddits, right? Rubrik. What other companies have been public? Those companies have had relationships with the major banks for 2 or 3 years in the private sector, and these major banks may even have some money in these deals.
So they're
Tied
influenced.
in for 3 years. It's not like, hey, I'm Reddit. Hey, Eric, you're Goldman. I'm thinking about going public later this year. No, the guy Goldman he's talking to, he's known him for 2 years.
Yeah.
So there's
They already
established-
have a relationship.
They
with
have
them.
relationships. So it's hard to tweak that when the guy Goldman's like, yeah, hey, here's how we'll do it. This is the way we take companies public. Yeah, retail. Yeah, you don't have to do that. They'll buy it in the aftermarket.
Mhm.
So it's going to take some change where somebody says, hey, no, this isn't right. Like, I want to do this the right way. I do think retail. But for us to get to these issuers and establish these relationships, but there isn't an issuer that we haven't talked to that hasn't said, yeah, hey, that makes a lot of sense. I want to do a chunk of my deal through you.
So you mentioned that earlier, that a lot of the newer companies, younger, not to sound ageist or whatever, but just the younger generation CEOs just have grown up with this idea of DEI,
Mhm.
and they want to include everybody.
Right.
So is there, I feel like there's got to be a way you could use social, how do you, they may not even know that this is an issue at this point, right? So how do you get that? How do you start to approach them and make them aware that as they're starting to consider this is something that should be on their radar early on? Like, how do you do that? You understand what I'm saying? Like, they're thinking about making their company work and being successful with the idea that they have. They may not know that, oh, as I start to approach these banks to take my company public, this is something I should be aware of.
Well, I mean, and I've thought about that for, our company, which isn't, we're not capitalized with tens of millions of dollars to do like a PR and a marketing campaign
Yeah.
on social media and do it everywhere. And we're a little bit restricted on what we can and can't say because, I have 5 securities licenses. So you got to be careful. Like, by the way, anything in this interview is not investment advice. Don't listen to anything I say.
I was going to
It's
say
not a
that
recommendation.
we had talked about that.
We talked about that. So I got to be really careful. We got to be careful about what we market or advertise or what we say because you cannot, misrepresent something when you have a securities license. You have to be really careful. Everything we do securities wise, I got to file it. When you get a copy of this done, I got to send it to the regulators and say, hey, by the way, I did this podcast.
Right.
And they're going to look at it. And they're going to make sure I didn't say anything
We talked about that. And that's something I think is interesting for people to know. So Scott, right now, being a licensed, what's your title? Licensed financial advisor.
Yeah, licensed. I've got a Series 7, which is a federal license, a 63 is a state, a 65, which is I can manage money for a fee. I've got a 24, which is a principal's license, meaning I can supervise, and then a 79, which is an investment banking license.
So the fact that you have all these and maintain all these licenses then puts you in a position where you're at much higher risk even having a conversation like this.
Way higher risk.
Versus like I'm like reading on Yahoo Motley Fool, or I'm like watching Jim, whatever the hell his name is, on television.
Kramer.
Those guys can say whatever the hell they want
Right.
because they're not licensed.
Correct.
And they could just turn around and be like, well, I'm just entertainment.
And the next time you see Kramer on there, you notice right before after the show, hey, none of this is investment advice.
Right.
They put a disclaimer out there, but basically he doesn't have a license, so he's got.
He doesn't have a license, so he can say whatever the hell he wants.
Correct.
And he's
If
not.
you have a license, you can't. You got to be. That's where there's a lot of guys in the securities business that get out and they're like, hey, I don't want a license again. When you have a license like this, if you and I opened a Kool-Aid stand, I got to disclose it to the regulators. If I buy stock in some company, I buy $100 worth of Denise's company, I gotta disclose that to the regulators. Any outside business activity,
right?
You got to tell them what you're doing. I mean, so it's just like they want to know everything that you're doing.
Going back to this, like this isn't. Those aren't even SOX rules, right? Those are rules that the FINRA put in place even prior to 2002.
Yeah.
Right? So it just seems a little, not being within that industry at all. I don't know. It seems like there's something broken that people can be.
It's like as a broker, you are so having a license. It's ridiculous. I mean, I went through a divorce 4 years ago. I had an IRA with 20 grand in it. IRA at a bank, and my attorney said, "Don't touch it." Okay, wait till the divorce is through. We're going to split the money, whatever, or, figure it out. Well, I didn't disclose it, and when the SEC came in and audited us, they were going to write me up because I didn't. Because apparently that IRA I had at a bank with 20 grand in it, I could have bought a mutual fund, which is a security. So technically, it was a securities account. You got to disclose all your securities accounts. And I'm like telling the regulators, hey, look, it was just cash in an IRA. Like they're like, well, you should have disclosed this. We should write you up in that. I said, well, here's a letter from my attorney. It said, don't touch it. Just leave it. I didn't even know I could buy a mutual fund at the friggin' bank for this IRA.
So I mean, what?
But it's like it's that kind of stuff. Like they're just looking for you. Like it's so like if you make any kind of little small mistake,
Yeah, and again, it's going back to where they feel like this is protecting me as a retail
Right.
investor, but in reality, it's just making it more costly for the entire
Well,
system.
it's more costly, and then because of this, there's compliance that has to monitor all this.
Yeah.
Your compliance at your firm, they got to monitor everything.
Right.
I mean, it's overboard, and that's why you got a lot of good people. They don't want securities licenses. They don't want to be subject to that scrutiny. You tell anybody that's got a securities license not doing it anymore, and they run a hedge fund or do something else, you're like, yeah, there's no way I'd have a license again. It's ridiculous.
Interesting.
Because any business activity you're up to,
So the oversight it's like well-meaning, but it ends up shooting us in the foot.
I think it does. I mean, it's gotten worse. It's worse now than it was. I mean, it wasn't bad 20 years ago, but man, it's horrible now.
So, and was that a result
that's
of
why
all the dot-com crash and that sort? What is that? Why it's worse now? Because it just did get so.
It's
You had
more regulations
some bad
to protect retail
actors.
investors, but that's why there aren't any brokers that have retail investors they recommend anything to. They put them in managed accounts.
Yeah.
And then if you're in a managed account and you walk in and say, "Hey, I got $1 million. How should I invest it?" All right, Eric, you're 45. You're gonna retire when you're 60. Whatever. They'll have a computer program they use.
Yeah.
That says, here's how you should invest your money: 100 grand in a REIT, 100 grand in the S&P, 100 grand in bonds, blah blah blah. And they'll show you the computer program. Hey, here's the way you should invest your money. And then you put your money in, whatever, and then they charge you, 0.5% or 1%, and they collect that fee every quarter. They collect, a quarter of a point or whatever.
I have a Edward Jones account, so that's how it
Okay,
works.
yeah. So but that's a lot safer. It's safer for the firm.
For them.
It's safer for the rep.
Yeah.
And, they try to put you in safer stuff and they have a lot less liability, and then they clip their percentage on the way by. When the truth is, all you got to do is go buy SPY. It's the S&P 500. Just buy the SPY. You don't need a financial advisor. And
yeah, Buffett proved that, right? He beat all the hedge fund investors by just
buy the SPY.
Just buy the SP.
Because professional money,
So okay. So I want to, because where are we at time wise?
We were, almost at an hour 45.
All right. Because I'm going to have to use the bathroom soon. So
yeah.
I think we're kind of wrapping this up here. But so I think, as far as like just solutions, I'm really, man, I would love to have you back on because I want to hear what happens with the SEC conversation. Like, what did
Have
you
me
talk
back on in 3 months?
Yeah. What did you talk to them about? Were they receptive? What are some of the ideas that came out of that conversation? Because it does seem, after talking to you, it seems pretty obvious to me that the current, at least in the U.S., the current system is broken. At least it's not fair.
It's totally broken.
Yeah, it's totally broken. And so it's like, but what can we do, as average people? Like, I don't have a voice besides this podcast. Like, I don't have a means to go make that change happen. Right. Like, and so what can I do, or what can people watching do to try to like provide a force of change? Like, is it trying to just get the word out to those young CEOs? Like, hey, we want you to engage with Click and whomever else to make sure that we have access to your IPOs. Is it just like via social media? Do we talk to our local representatives and say, this is something that we want you to bring up in committee? Like, what can I do as an average person to help start to solve this problem?
I think a voice needs to be heard. I think on social media, anybody you talk to, I think talking to your representative, your congressman, I think those things could be helpful. It's got to look, what I'm talking about, it's going to happen. There's I don't know how many smartphones around the world, but everybody with a smartphone around the world can open a brokerage account in almost any country. So you can open an account in Mexico, you can open one in China, you can open one in France, England, wherever. And you get access on your smartphone. And all those investors around the world, you know what they want to do? They want to invest in the U.S. markets because it's the safest. And in the U.S. markets, they want access to hard-to-get products. And the sexiest of them all that people want access to is IPOs. So there's a guy in frickin' Antarctica that can buy an IPO on his smartphone, provided we're connected to the network, right? And that is really, really good. It's good for everybody. It's good, everybody gets to participate.
Yeah.
It's a great model. And that will happen because it's going to happen. It's inevitable that that's not going to happen. The trades on the New York Stock Exchange and NASDAQ was like 5% individual investors 20 years ago. Or 15 years ago. Right now, it's 25 to 35%, depending on who you believe. So it's expected to be over half the trades. Not the volume, but the trades, right? Because the retail trades are smaller than institution. But there's this massive pipe of people that want access. That's why I mean, there's robo-advisors now. You don't even need an advisor paying, a robo-advisor, you pay them 1/10 of 1%. Does the same thing as a financial advisor. It's the same computer program. That became, where somebody says, hey, I don't have $1 million to invest. I got $5,000, but I want to save it long term.
Yeah.
Hey, a robo-advisor, boom. You go in, it'll distribute your assets and buy it. It'll rebalance it every quarter, every year, however you set up. I mean, it's going to happen.
So you see it, the the advent of the online brokerages. Am I using that term right?
Smartphones.
The smart, the fact that people have, we have pocket computers that give us applications to give that access to. So really, it's down to there's still the problem of the banks that are actually managing and creating the IPOs, having the issuers require a certain amount, a certain percentage,
Correct,
offered to retail. So
it's either the issuer requires it or there's some government legislation
or something
for it. So one of those two is going to ultimately, will ultimately happen because.
I say we just attack both. We go in both directions.
And when our pipe gets big enough, which it is this year, and when we do a name brand big enough deal, like we get a Reddit or a Rubrik or a SpaceX or some major deal where we do a chunk of it and it comes public at 20 and opens at 25 and goes to 35. And then we can advertise and market out there like crazy and send press releases, stuff like that to every issuer. Hey, we did this through a global distribution pipe. It's the best thing that ever happened in this company.
Yeah.
Then you're going to have other issuers saying, hey, you know what? I want to use that pipe because that makes a lot of sense. And then they can tell, and think about this, you're an issuer and you got, 2,000 people working for you and your company's doing $1 billion a year in revenue and you're making 50 million and you're growing like a rocket ship. You can tell them, hey, listen, through Click Capital Markets, we're going to distribute half our deal to retail investors around the globe because we love you guys. We feel good about this. We want everybody to participate.
Right.
And when somebody hears that, they're going to be like, you know what a cool company. You know what, I'm going to support that because that guy's trying to help the little guy.
So if in the future, if anyone's watching this recording and you're in a position, you're a CEO or whomever else, and you're in a position to take your company public, consider that.
Hey, and by the way, all of our partners, and we've got about 10 or 11 partners, we'll have north of 20 or 25 when this podcast, once you edit it, we're going to link it and send it to everybody.
Nice. Okay, cool.
So
I'll let you take a look at it when we.
Yeah, I'll look at it.
So so YouTube, it'll be as soon as we're done, it's out there, So unless there's something like that we want to take out, I'll just leave it.
I'm fine with it the way it is. I didn't know if you were going to edit it or not.
I mean, I might edit the beginning out.
Yeah.
But yeah, for the most part, it's out there.
Nobody wants to hear about who I am or anything.
No, I don't mean that. I'm saying the beginning where I did start it at 3, and I was like, hey, Scott's stuck in traffic, and then I was on for maybe 45 seconds, and then you rang the door. So then we just switched over to a be right back screen. So I might edit that part out. Okay. But cool. No, this has been good, man. I want to have you back after you talk to the SEC because I want to hear about what they say. Were they receptive at all?
Let's talk sometime in April.
Yeah.
That'll be good. Give me 3 months.
Yeah, that's cool. I'm hoping that they're receptive. It sounds like they're more receptive now than they were when you talked to them in the past.
Well, I think they will be, so we'll see.
Yeah. Well, hey man.
All right. Cheers.
Dude, thank you so much for coming on.
With you. Kind of.
Yeah. We're good. Yeah, the last time I had this much left by the end and I had to pound the whole thing. I almost spit it up all over the place. I do want to say, so before we finish up here, Denise, thank you very much for managing or directing the stream for us here. I really appreciate it. My incredible partner, companion, intelligent, beautiful girlfriend here. And Scott, thanks again for coming on.
Absolutely.
It's been good to talk to you.
Yeah, we'll do it again.
It is fun. Yeah. And it's kind of cool too because it's I was thinking about it. I'm I'm going to go full Trump with this because I can say whatever the fuck I want. This is my channel, man. I don't care if anyone agrees with me.
Eric and Trump.
I could say whatever the fuck I want. This is my channel. I have nobody to answer to. If I want to say something, I can say it. You can believe me or not. I don't give a shit. last day. She was the Colorado Eagle County recorder, clerk and recorder. So basically what that role is, it's an elected position. She ran the elections for Eagle County in Colorado. So we're going to be talking to her. I have a lot of questions just on like, how does that work? How do elections run? She has some really interesting stories about all of the people who called her office and were concerned about election integrity after 2020. She being in Colorado, she had some insight into the whole Tina Peters shit that went on, who she's currently serving time for some of the stuff that she did. And so should be a really interesting conversation. So I don't know the exact time yet, but yep, on February 6th, if you guys want to come back and tune into the conversation with Regina on just how our elections are run, please come back. And thank you for tuning in today. And Scott, thanks again, man.
See you, brother. Thanks.
Thank you very much.
That was fun. Thanks, Denise.
Yeah, it was fun. I like
Keeping us on track.
Yeah. So, all right, everybody. Thank you very much. We're signing off. And if you can switch to the thank you screen, we're good.
Title.
Credits, yes.